So the skyrocketing house prices, as you guys know, in the past year, they've created a huge jump in unmet demand. And there are a lot of would-be buyers who were saving up for a down payment only to realize that it's still not going to be enough. So if you're still interested in buying real estate, there is a way that you can without buying the actual property, without owning anything. And we're going to get into that today. Hey everybody, it's Ken McElroy here. I have over 30 years of real estate investing experience, and I'm here to share with you how it's done. But first, if you enjoy our content, please be sure to click the like and subscribe button so that you'll never miss any of our videos. So how are people investing in real estate without actually owning any real estate? It's through real estate investment trusts, or REITs. These are companies that own, operate, or finance income-generating real estate. People who invest in REITs, they can reap the benefits of inflation and increasing rents. But there are a few things that you should know about REITs to maximize your actual investment. So REITs are popular with investors who want to own a piece of property without actually owning the entire property. There are a variety of reasons why this can be appealing. The obvious appeal is that the buy-in is so small. If you can't actually afford a down payment on a building, buying a share of a REIT, it's a lot more affordable. The other appeal, of course, is that it's truly passive investing. If you just want to park your money somewhere and let it grow, REITs can be an excellent option. You don't have to worry about the calls from tenants or scheduling the maintenance visits or showing the vacant units or any of that fun stuff that property owners have. REITs tend to have a specific focus of the types of properties that they hold. There are also many diversified REITs that may hold many different types of properties. These can include apartment communities, single-family homes, retail centers, office space, data centers, healthcare facilities, hotels, office buildings, self-storage, and of course, warehouse. The main advantage of a REIT is that you are able to buy into one at any dollar amount that you like. Also, because your investment is tied into real estate, your dividends will be based in part on what the properties are renting for, and the rents tend to increase more quickly than inflation. This chart shows the different types of REITs and their 2019 returns. So what REITs do is they pull the resources from a multitude of investors who then receive the dividends from their investment without ever having to actually buy anything. A lot of REITs are publicly traded and investors can buy and sell shares in them just like a stock. It's the easiest way that someone can invest in real estate. So REITs really took off in 2020, as this chart shows. But they've been around since 1960, when Congress first allowed the formation of REITs. Here are some strong pros and cons to REITs. Also, if you like, I wrote a simple cheat sheet on REITs, which you can download at kenmcelroy.com/REIT. That's kenmcelroy.com/REIT. Okay, so a major advantage of REITs is that they offer portfolio diversity. REITs are a different class of investment than stocks or bonds. Real estate often responds to different market forces than those types of investments. So if your stocks take a dip, that doesn't necessarily mean that your REIT holdings will. Another advantage of REITs is that they're required by law to pay at least 90% of their income as dividends. Next, REITs pay zero corporate tax. So the REIT's earnings are passed directly onto you, or at least 90% of them are. You're on the hook for paying taxes on your dividends, but you aren't double taxed on your investment. The last advantage is the liquidity of investing in a REIT. If for some reason you need to pull money out of your REIT investments, you'll be able to liquidate it quickly. There are also a few drawbacks that you should be aware of. One issue is that because REITs don't pay a corporate tax, REIT dividends are usually taxed at a higher rate than other investments. Dividends from REITs are usually taxed at the same rate as a person's ordinary income. REITs are also pretty sensitive to interest rates. Rising interest rates can spell trouble for the price of a REIT stock. Generally, REITs are better as a long-term investment. As with most investments, you want to invest for the long term more than the short term. Even though home prices have been increasing year over year, that's only one segment of the real estate market. When contemplating which type of REIT to buy, be certain to find out which types of properties they're investing in. About 80% of REITs hold commercial and industrial real estate, including offices and shopping centers, which have taken a hard hit during the pandemic. So the correlation between rising rents and a REIT's profits isn't always a straight line. Most experts recommend investing in REITs as part of a diverse portfolio. If your game plan is still to eventually buy property, that's wise advice. REITs are a good way to capture the rising profits in real estate without a lot of risk. But you need to know what types of real estate you're investing in. Also, if you're shoring up resources to save for a down payment, be extremely careful about storing your money in a fluctuating asset. If real estate prices were to suddenly drop, for example, so would your investment. There's definitely opportunity with REITs, but just make sure to do your homework first. Thanks again for watching, guys. We'll see you in the next video.